10 best investment ideas for you in 22-23. To enjoy a comfortable financial future, investing is essential for most people. As the COVID-19 pandemic demonstrated, a seemingly stable economy can be quickly turned on its head, leaving those who weren't prepared for tough times scrambling for income. Investing can provide you with another source of income, fund your retirement, or even get you out of a financial jam. Above all, investing grows your wealth, helping you meet your financial goals and increasing your purchasing power over time. In this video, we'll explain the best investment ideas for investors to make in 22-23. A high-yield savings account is similar to a traditional savings account, but it can pay 20 to 25 times the national average of a standard savings account. As far as safe, high-yield investments go, this is certainly one of the safest, since deposits are insured, meaning in the event the bank goes under, your funds are protected. While high-yield savings accounts offer a higher yield than standard savings accounts, they won't pay enough on their own to meet long-term wealth goals. Instead, they're best for meeting short-term savings goals, like buying a car or building up an emergency fund. A certificate of deposit. A certificate of deposit, or CD, is a type of savings account that earns interest on a deposit for a fixed period of time, typically at a higher rate than a standard savings account. CDs are structured by term length, or how long the money must remain in the account before you can withdraw it without penalty. Term lengths can range from a few months to 5 or even 10 years. CDs are on the safer end of the risk spectrum, and deposits are also insured. That said, your earning potential is bound by the rise and fall of interest rates. Since your money is locked in for the long term, you could miss out on increased earning potential when interest rates rise. In this case, it makes sense to go with a short-term CD so you can reinvest with higher interest rates in the future. In general, you can earn more with a CD compared to a high-yield savings account for the trade-off of having your cash locked in for the term length. A money market account is another type of insured savings account that earns interest. They're almost identical to a CD or high-yield savings account, except they offer more ways to withdraw your money. Money market accounts are best for those seeking a low-risk investment that still offers access to cash when you need it. Like a high-yield savings account, they work well as a short-term savings vehicle for near-term purchases, like a car or building up that emergency fund. Government bonds. When you purchase a government bond, you're essentially loaning the government money, which is used for things like paying off national debt or funding infrastructure spending. When a bond is issued, the investor is paid a certain amount of interest on an annual basis, making them a fixed income security. When the bond term ends, the principal amount of the bond is repaid to the investor. Government bonds are some of the least risky investments out there, since they're backed by the full faith and credit of the national government. In turn, the returns aren't nearly as high as other investments like stocks. ETFs. An ETF, or exchange traded fund, is a basket of stocks that pool money from investors to buy a collection of securities, which are bought and sold just like individual stocks. They're well suited for young investors with a long time horizon and are ideal if you don't have the time or experience to research individual stocks on your own. ETFs also have a low barrier to entry. You don't need a huge amount of capital to get started. So if you want to begin investing but don't know where to start, ETFs are a good option. S&P 500 index funds. If you're looking for investments with high returns, S&P 500 index funds will likely earn you more than any savings account or government bond, at the expense of being more risky. Purchasing an S&P 500 index fund means investing in a basket of stocks that follow the S&P 500 index. These stocks are based on 500 of the largest U.S. companies such as Apple, Microsoft, and Amazon. The goal of an index fund is to provide returns that mirror the performance of whatever index it tracks, as opposed to an actively managed mutual fund. They have the benefit of instantly diversifying your portfolio, since you'll own shares in a basket of companies in a variety of industries. Mutual funds. Like index funds, a mutual fund lets you invest in a variety of stocks, bonds, and other securities. The difference between the two lies in their objective. While an index fund seeks to match the returns of a given stock index, a mutual fund aims to outperform the market. Mutual funds are also actively managed by a paid professional, which chooses the stock holdings that make up the fund. This means that mutual funds come with higher fees than index funds, which can cut into potential gains. Dividend stocks. Dividend stocks offer both the periodic income of bonds and the higher growth potential of stocks. A dividend is a portion of a company's profits that are paid out to investors, commonly every quarter. While any investor can benefit from dividend stocks, they're usually favored by investors who need income in the short term but can still stay invested for long periods of time. While dividend stocks don't usually grow as quickly as growth stocks, many investors favor them for the stability they provide through regular cash payouts. There are many companies you can buy dividend stocks from, and if you're buying individual stocks, as opposed to a stock fund, you'll need to do your research up front to reduce your risk. Real estate. If you're looking for safe investments with high returns, consider real estate. It's a highly favored avenue if you want higher than average returns, and while it comes with its own set of risks, real estate is known to provide stable value in the long term if managed properly. Real estate investing involves buying a property and selling it down the line for a profit, or renting it out to create a source of fixed income. One benefit of real estate investing is that it doesn't lose value when inflation is high. In fact, it can perform even better. You can capitalize on real estate passively as its value naturally appreciates over time, or you can put more work into the property to boost its value even further. Either way, real estate is a solid way to earn a reliable stream of income. Cryptocurrency. Cryptocurrency is just a generic term for any virtual currencies using blockchain technology. It's become an increasingly sought-after investment in the last few years, with Bitcoin being the most popular form of crypto. Investing in cryptocurrency is not for the risk-averse investor. Bitcoin has had large price swings over the years. Its market cap reached an all-time high in April of 2021, soaring past $1 trillion before declining to $600 billion in June of 2021. After peaking again in October of 2021, its market cap now sits at $443 billion. All that to say, with high risk comes the potential for high returns. Investors who can stomach the volatility of this emerging market may find it to be a highly lucrative investment if you know what to look for. Thanks very much for watching our video. If you like it, give it a like, and if you want more interesting content, don't hesitate to subscribe to our channel and hit that bell icon.